Welcome back. The major averages heading for their third negative day in a row. Here with where he sees the market heading now, Trivariate Research and CNBC contributor Adam Park. It's good to see you.
Hey, Scott. How are you?
Does that smile match how you feel currently about the stock market, or are you a little concerned that we might be vulnerable?
The smile was because I was happy to see you. The vulnerability, I think, is, look, what am I worried about? I'm worried that, when I do my meetings now, people who were cautious 6 months ago are bullish, that it's hard for people to articulate a bear case, meaning I can tell you what I'm worried about, but it won't be something I can pre-position for, meaning, yeah, sure, the CarMax auto loan number, it's a little worrisome. If Visa or MasterCard's slow, if 90-day credit card delinquencies grow, we can point to things that contemporaneously would make us worry. But people are struggling to point out things that proactively make us worry. One of the things that I've learned doing this for all this time is there's two things that are always in place when the market sells off. One is hubris and two is debt, right? You get arrogance run amok, crazy stuff happening there, and you get too much leverage. On the margin, I'm a little bit worried about some of the debt stuff coming in. You look at Oracle's big number. There's some other things that are happening. I don't think it's time to say, hey, this hyperscaler CapEx is phony, and I don't think that's right. But I do know everything's cyclical, and the whole debate in my meetings down here this week, et cetera, has been how am I going to time when I get worried about this investment? And my answer is not yet, but it'll be in the next 2 years because everything is cyclical, not structural.
Because you're having those types of conversations, does that suggest that the AI trade, sort of everything hinges on that, and if that cracks, we're in trouble?
I mean, you pointed it out earlier in the show, and I think the challenging or worrisome thing if you're a portfolio manager is all of the growth themes are correlated. What do I mean? Electrification industrials, Eaton, power, Constellation, Vistra, GE Vernova, semis, NVIDIA and the group, and then alternative asset managers, right? You said they're struggling. They're all the same trade. And I think that's the biggest problem is so much of the market cap and the momentum are around what you think are in different sectors of the market, but really are associated with the AI trade. I think that's the biggest risk, that you get fears about the productivity, and you need some proof cases. On the contrary, I still think that these current fears aside, that the two things that are the tenets of the bull thesis are in place. One, the distribution of the outcomes for the Fed is skewed to being more dovish. That's usually supportive of risk-taking. And two, that we've always known that AI productivity was going to be 2027 probably, and it's still too early to fade that dream at this point, that'll ultimately be what buoys people. So what do we need? We need in next year, in 2026, some cases from Walmart or McKesson or other businesses that have a lot of revenue and low margins and lots of employees telling us that they're being more productive. If that's in place, of course, we'll end up at a higher place than we are now. But I am a little bit worried that we will get a first half of 2026 concern if we see more debt and more arrogance come through. So that's sort of the balance here as we try to thread the needle.
I mean, as we continue to get these headlines of, we can just frame it as the president versus Lisa Cook. Where does Fed independence factor in to how you see the current environment? If it ends up that the Supreme Court says that the president has the authority to fire Lisa Cook, is there an impact in the market one way or the other? How do you assess that?
I try to think about it as a distribution of outcomes, meaning what could happen under different scenarios, what probability do I assign to each scenario, and when I kind of do that thinking, it makes me think the skew is to more dovish. Independent or not, it just seems like we're going to end up with folks who are more dovish. One thing I know I won't fight is balance sheet expansion. So if they get that, if that changes, we'll have to get even more bullish. But I think right now that bias is to be a little bit more skewed to dovish from where they are now. And, the 10-year yield's been very stable. I think there's a difference between steepening of the curve where the economy's great and the 10-year yield backs up versus just the front end comes down. So I don't know what I'm worried about. Yeah, sure, I'm worried as an American about that. But I'm not as worried about it from the risk-taking perspective because I think the skew is more dovish, and that's probably good for U.S. equities.